So what the heck is all this rising interest rates and the Fed and the inverted yield curve? What does it all mean? So those of you who don't know me, my name's Adam Kahn. I'm the Rational Investor. I hope your day's going well. Today's Friday, September 22nd, I think. I'm going to move that over a bit. So I thought I'd talk a little bit about how the Fed works, what they're doing, why they're doing it, and what the inverted yield curve indicates. A lot of people talk about that 100% of the time when the curve inverts that there's a recession. Maybe that's true, maybe that's not. It's not really 100% of the time. And like everything, things change. And usually when you expect things to be one way, sometimes they don't quite go that way. So those of you who don't understand it, what the Fed controls is the overnight lending rate. That's what they loan to the banks at. So when you're a bank and you do mortgages and finance and you lend, you also borrow on the other side and you borrow from the Fed, and you just do that overnight. You keep doing it every day over and over again. So as the Fed raises those rates, that's the rate that the banks borrow from the Federal Reserve. Now, bonds trade on the open market and they fluctuate wherever they fluctuate in terms of pricing. What ends up happening with the inverted yield curve is the Feds raise rates essentially from 0 to 5.25 on the overnight lending rate. You see short-term lending, which is 3-month CDs and treasuries and 6-month and 9-month, even out a year and 2 years, right around that 5.25, maybe even 5.5 type range. But as you start going out further out, where generally if you're lending money for a longer amount of time, you typically want a higher rate of return because that money's out longer and you're taking bigger risk as to things that could change in the economy. Well, right now, if you look at the 10-year bond, it's only paying about 4.4%. So it's inverted. Normally it's a natural curve that would, slowly rise. But if the 10 years lower than the short term rates, it's actually going down like that. And then the 30 years a little bit cheaper as well. That's not typical. Well, just this past meeting, the Federal Reserve did not raise rates. They indicated that they're probably going to raise once more this year, which I don't really understand. I'm not sure that another quarter point makes any difference one way or another, outside of what it indicates to the markets that their path is still along the tightening range and not relaxing and lowering rates. However, what's odd to me about that is the economy's slow. And this is one of the rare times you can buy bonds and actually be net positive against what the actual inflation rate is. So CPI came in at 3.7%, and that's our indication of what inflation's at. Normally, bonds pay a little bit less than inflation. You're generally lagging behind, but they have the security of they're pretty much as close as you can get to guarantee. Well, right now you can actually buy bonds and outperform the inflation rate, which is pretty impressive actually to be able to do that, especially if your pockets are pretty deep. What's odd to me about that is I don't really see the need of why they would continue to raise if they're ahead of CPI. I think that where the Fed misses the boat, they tend to act too quickly and they tend to seem to go too far. Whether that's acting late, which is very common, and we saw that during COVID, that they kept rates too low for way too long. Now, I do mortgages as well, and quite honestly, I was calling as many as people as I could because I thought that was a once in a lifetime opportunity when rates were being brought down that low. And I thought the same thing. I mean, the economy seemed to be chugging along and doing okay, and they were still holding the rates down. I couldn't really figure out why the rates were staying so low so long when house prices were going up. Things were getting more expensive. That's when they should have started raising them. Now, I don't want to beat a dead horse and pick on them for being late to the party, but I think the mistake is when they've gotten ahead. Now, inflation shot up and CPI went as high as 9% at one point. It's come down rather quickly to around 3 to 4%, which I was born in the early 70s. 3, 4, 5% inflation was pretty natural. And this 2% target that they have, just so everybody knows, that's just some made up number that they've decided that that's where they have to be. The problem I see is my guess is if they get there, they're going to overshoot and run back right to where they were. They'll probably cause a little too much unemployment, which will be hard to reverse. They'll end up having to cut rates to save the economy. And more important, something that nobody's talked about is they've also said that they're going to start getting out of bonds and easing up their balance sheet as well. Well, if there's no buyers for those bonds, that's going to start pushing the rates up as well. More so even than what they're doing with raising the overnight lending. Now, back to the original point is I think we're in a decent range. The fact that the economy is still strong, I don't really understand what their goal is at this point because 3-4% inflation isn't too bad. Why you want to push so hard and get to the point that you cause the unemployment and crack a bunch of companies and put them out of business just seems like a big mistake to me. So the inverted yield is kind of an indication that things are going to slow down in the future. What I would have hoped is the Fed would stop and you'd see the curve start to uninvert. Now, that would naturally push mortgage rates higher and borrowing rates higher on its own. But it would also indicate that the economy is actually catching and doing well, which is a good thing, not a bad thing. They're so scared of inflation. I mean, petrified. What they should be scared of is what's called hyperinflation. 3-4% inflation is not hyperinflation. That to me is a natural economy. Pinning it down to 2 is a little bit slow. And if you get into hyperinflation, well, then you look to raise rates again. But at this point, the fact that they know things lag, why wouldn't we be waiting 6 to 12 months to just see how things take effect instead of trying to put out of business some companies and probably some of the commercial real estate that we've heard a lot about? Because here's the problem to me. If you have a multi-billion-dollar company, I won't give any of them a name. I won't point to any of them. They get to walk away and or restructure deals and really put the local banks in tough positions. But if I owned which I don't, but if I owned a piece of commercial property, yeah, they'd put me out of business. If I'm locked in for a 5-year period on an adjustable rate and I got in when rates were close to zero and I'm paying maybe 3-4% on a commercial space and my loan seasons and then it pops up to 9%, odds are I don't even qualify for the loan anymore. And then those big multi-billion-dollar companies can come in and swoop it up. I don't see the value of squeezing out small people to allow the big companies to continue to pick up good deals. It's not really going to make the economy do better. That's not good for people. That's just the big getting bigger and the small having to like become these robots that just work for these big conglomerates and big corporations. I don't see real value in that. And that happens all the way throughout. And the interesting thing that I see happening with real estate is the higher rates go, the less inventory there is coming to the market. So I see a really hard scenario of seeing prices come down. I understand that they're killing demand. I get all of that. But here's the problem. As rates go higher, the people who got into homes years ago or refinanced when the rates were in the twos, threes, and fours, well, they're less likely to list their property. But the other part to that is even the builders, KB Homes, DR Horton, and all those others, they borrow to build homes. Well, if interest rates go up, they're going to slow their building because it costs more to build the homes, and they're not going to build on speculation to try to meet the demand. So they're really stuck in this weird spot with housing. I almost worry that we're going to have something that happened. So in California in the 70s or in the 80s, their markets just went stagnant for a long time. Prices shot up and it got expensive, and then the buyers disappeared. And it sat that way for a really long time. There was just no transactions. There were a few distress sales from time to time, but the bulk of the market just kind of stopped doing anything. I almost see that as a possible scenario that we could see going forward for us in the housing market because of the rest of the economy. Friends of mine who do other things, they're doing just fine. Like they don't like the inflation, things are costing more, but their businesses and their jobs, they're still working. They can't afford all the things they used to afford, so they've had to cut back. And as the Fed does this more and more, they really hit the little guys because what'll happen is companies are going to start letting people go. And they're typically not letting go their corporate buddies or the people on the top. They're typically just trying to cut back on the lower end and they're going to automate things. They'll do more self checkout at Target or the grocery store or Walmart, which we already see. I saw that McDonald's opened up the first, I have to see how it's doing, but the first store that has no employees. Now they don't have dine in, it's drive through only, but my guess is when they do the analysis, that's going to be a really good model and others might follow suit. So they're going to continue to beat up on the wrong people. And it's just not going to work out the way they think because of their fear of what happened in the 70s. Guys, that was 50, 60 years ago. It's not the 1970s anymore. Things have changed. Your AI tools should be able to tell you that. I think we landed the plane really well, and to keep going is just going to cause a crash. What I'm hoping is the things we saw a couple days ago at the meeting and the things that Powell said were comments to just try to keep the market from getting ahead of itself, but not the truth. That's my real hope. And we have an election coming up next year. I'm hoping that they don't want to collapse an economy going into an election. I mean, typically on election years, economies do pretty well because there's a lot of spending for the election. So there's a lot of interesting information about that as well, about how AI is going to impact the election next year, and I'm interested to see how it plays out. Anyway, do me a favor before you guys forget. I'd really appreciate it if you've lasted this long, even if you haven't. And somehow I can tell you this in the beginning because I forget all the time. But subscribe. If you can, hit a like, give a thumbs up, chime in, make a comment. I'm happy to discuss any of it. I love markets, I love chatting it. I don't get offended when people disagree with me, so tell me why I'm stupid or I don't know what I'm talking about. I'm happy to talk about all of it. Have a great weekend. I'm sure I'll talk to you tomorrow or the next day.